So here's our instructional roadmap for this explainer. First, grasping business goodwill. Second, method 1, average profit. Third, method 2, super profit. And finally, method 3, capitalization.
Okay, let's dive right into section 1, grasping business goodwill.
Our source material gives us this beautifully simple definition. It says goodwill is the probability that an old customer will resort to the old place again and again. So going back to our bookstore analogy for a second, goodwill is that invisible pull that keeps your loyal customers returning instead of just, buying their books online. It's an intangible asset. You can't see it, you can't touch it, you certainly can't transport it in a cardboard box. But from an accounting point of view, it is a very real, very saleable monetary value, simply because it represents the capacity of a business to earn expected future profits over and above the normal rate.
So what actually creates this invisible pull? Well, if you're a junior analyst looking at a firm, you really want to look at these real-world factors. The quality of the goods sold plays a massive role. So does the personal reputation of the owners, their unique ability to attract customers. Location is huge, for sure. Think of a shop holding a prime position in a busy, congested market. And finally, possessing near monopoly rights, like maybe being the main regional agent for a specific vehicle brand, can significantly boost that goodwill.
Let's look at how this plays out with a hard number. Our source gives us a great, straightforward example. Imagine that small book business we talked about has a net worth, meaning its tangible assets minus its liabilities, of exactly $140,000. But a purchaser comes along and is willing to pay $150,000 for the whole thing. That extra $10,000 they're willing to just hand over, that is goodwill. They're paying that premium because of the future capability of that favorable location or that stellar reputation to earn more profit than normal.
Now that we understand exactly what goodwill is, let's open our toolkit to method 1, average profit.
This method involves adjusting the average profits of past years. But here is the absolutely crucial instruction you need to follow. You have to look at the data first. If past profits show a clear increasing or decreasing trend, you must use a weighted average, giving more weight to the profits of recent years. But if the past profits bounce all over the place, say they go from $30,000 down to $25,000, down to $20,000, back up to $30,000, there's no clear trend. In that case, you just fall back and use a simple average.
Once you have your average profit figured out, you multiply it by a certain number of years' purchase. And this number is decided based on judgment and negotiation about how long those past average profits are expected to actually continue into the future. So if your simple average profit is, say, $26,600, and you negotiate a 3 years purchase, you literally just multiply that average by 3 to estimate your future goodwill value. Simple as that.
All right, let's move right along to method 2, super profit.
Now, what's really interesting about this is how it shifts our perspective entirely to exceptional performance. Think of it as looking for the overachiever in a class of businesses. To find that overachiever, we compare two numbers. Normal profit, which is the average baseline return for similar firms working under similar conditions, and actual average profit, which is the overachiever's earnings.
And that brings us to this beautifully simple formula. Super profit is simply the actual profit minus the normal profit. It's the excess. It's the overachiever's extra credit. If the firm's actual average profit is higher than the normal profit expected for that specific industry, that positive difference is your super profit, and it proves without a doubt that goodwill exists.
So how do we actually calculate this? Follow these 5 practical steps closely. Step 1. Identify the total capital employed by the firm. Step 2. Find the average actual profit based on past figures. Step 3. Determine the normal rate of return, or NRR, prevailing in that locality for similar firms. Step 4. Apply that normal rate of return to the capital employed to calculate your normal profit. And finally, Step 5. Deduct that normal profit from the average actual profit.
Let's see those steps in action with the data right from our source. We identify the capital employed as $100,000. We find the normal rate of return is 22%. By applying that 22% to the $100,000, we calculate a normal profit of $22,000. But wait, our firm's actual average profit is $25,000. So we take that $25,000, deduct the $22,000 baseline, and we're left with a super profit of exactly $3,000.
Once you've successfully isolated that super profit, there are 3 distinct ways to translate it into a final goodwill valuation.
You can use the number of years purchase method, just like we did back in method 1. You can use the capitalization of superprofit, or crucially, you can use the annuity basis. The annuity method is really unique and vital because it actually factors in the time value of money. It discounts the value of those future superprofits based on an appropriate interest rate, acknowledging the fact that money received years from now is worth slightly less than money you have in your hand today.
Okay, let's enter the final stretch of our roadmap with Method 3, capitalization.
Under this basis, we aren't just looking at the extra profit, we are determining the value of the whole business, the whole shebang. Here are your 5 steps. Step 1. Determine the normal rate of return. Step 2. Find the firm's average profit. Step 3. Determine the actual capital employed. Step 4. Find the normal value of the entire business. And Step 5. Deduct the actual capital employed from that normal value to arrive at your goodwill.
And this brilliantly illustrates the core trick of this method, which we find in Step 4. How do you find the normal value of the whole business? Well, you simply take the firm's average profit and divide it by the normal rate of return. This tells you exactly how much capital should theoretically be invested to generate that specific amount of profit in a normal functioning market.
Let's lock this down with one final incredibly helpful example from the text. We have a firm with an actual capital investment, or net tangible assets, of $410,000. Their average profit is $60,000, and the normal rate of return is 12%. First, we divide that $60,000 profit by the 12% rate. That gives us a massive normal value for the firm of $500,000. Now we just deduct the actual capital invested, $410,000, from that $500,000 normal value. The result? A staggering $90,000 in invisible goodwill. I mean, they are generating profits as if they had $500,000 invested, even though they only have $410,000 in hard assets. We have built an incredible toolkit today, moving all the way from the abstract concept of customer loyalty to hard, calculated metrics using average profit, superprofit, and capitalization. So I want to leave you with this to ponder. Think of a local brand you absolutely love. You know, the one you return to again and again. If it's sold tomorrow, how much of its price tag do you think would be made up of that invisible yet highly valuable goodwill? Keep that in mind next time you walk through their doors. Thank you so much for joining me on this explainer, and happy analyzing.